Let's take a moment and dispel some of the common misconceptions about bonds and focus on why I believe bonds are still a viable alternative for you to consider today. As I mentioned, I know some of you might be thinking there's no way you want to buy bonds right now with interest rates so low, because as soon as they go back up, bonds will drop in value. As I pointed out, that a lot of stock market-based advisors and stock market-based Wall Street firms have recently marketed and publicized this very same thought that we might be in a bond bubble right now, and that you might very well want to stay away from bonds in case interest rates go up. I believe that this is primarily a scare tactic that's being used by stock market-based firms and stock market-based advisors who want to keep you invested in the stock market and want to prevent you from moving to the bond market. If you plan to hold bonds to maturity, it's a moot point. Additionally, as we said in our last video, one of the things that causes bonds to drop in value is rising interest rates. But I also said there are many other factors. One such factor is something called risk premium. The reality is that when interest rates go up, that's because the economy is doing well and investors are becoming more confident. At that time, they typically require a lower risk premium, i.e. less additional interest to go from government bonds to corporate bonds. What that does in the real world is partially offset the negative effects of bond values of an increasing interest rate environment. So again, the rhetoric that has existed for a little while now about the possibility of a bond bubble and interest rates going up and fixed income securities dropping in value, I believe comes from stock market-based advisors who are either ignorant about the factors that really do affect bond values, or by those advisors who are simply trying to impose a scare tactic to keep you fully invested in their beloved stock market-based products and vehicles.